Hey there. Welcome to Money Nudge. This is where we make money talk simple. Imagine it's 1999. The internet is brand new, and every company with a .com at the end of its name is suddenly worth billions. Your neighbor brags about doubling his money in a week. The news says we've entered a new economy. And then, in March 2000, it all comes crashing down. That was the .com bubble, one of the wildest financial events in modern history. And people still ask the same question today. Was it a recession or something else? So today, we're breaking down the .com bubble, what it was, why it burst, and whether it actually counts as an economic recession. The .com bubble was a period in the late 1990s when internet companies, the .coms, saw their stock prices explode. Investors believed the internet would change everything. And honestly, they weren't wrong. They were just way too early and way too excited. Think of it like this. If a normal company is a slow, steady jog, a .com stock was a rocket ship, strapped to fireworks, with no fuel gauge. Here's how crazy it got. Companies with no profits, sometimes no revenue at all, were valued at billions of dollars. Why? Because they had a website, a catchy name, and a promise. One company sold pet food online and lost money on every single sale. Investors said, "That's fine, they'll dominate later." A few things lit the match. First, the internet was genuinely revolutionary. Email, online shopping, digital ads, all brand new. Investors knew it would change the economy. They just didn't know which companies would actually survive. Second, money was cheap. Interest rates were low, and venture capital was everywhere. Startups raised millions based on ideas, not results. Third, speculation fed on itself. Everyone heard stories of overnight millionaires. Fear of missing out kicked in, and media hype poured gasoline on the fire. Old-school investing rules went out the window. Profits? Didn't matter. Cash flow? Boring. The new metrics were things like price per user and website traffic. The market wasn't asking, "Is this company profitable?" It was asking, "How big could this thing get?" Then, March 2000, the bubble popped. It wasn't one event. It was a slow realization. Companies started reporting disappointing earnings, massive losses, weak fundamentals, and the story of profits later suddenly stopped being convincing. Once confidence cracked, it shattered. The NASDAQ composite, the index packed with tech stocks, lost nearly 80% of its value. 80%. Thousands of companies went bankrupt. Trillions of dollars in market value, gone. Retirement accounts shrank. Venture capital dried up. Now, here's where it gets interesting. Was this a recession? Short answer, not exactly. A recession is a sustained decline in the overall economy. Falling GDP, rising unemployment, lower spending, less business investment. The .com crash was a stock market crash. Those aren't the same thing. A market crash hits asset prices. A recession hits jobs, wages, and what people actually buy at the store. The bubble bursting did eventually trigger a recession, the 2001 recession. But the bubble and the recession were two different events. Here's why people confuse them. The stock losses were huge. Tech layoffs made headlines. Investor wealth disappeared overnight. It looked and felt like an economic disaster, but the actual 2001 recession, it was relatively mild. It lasted from March to November of that year. Unemployment rose, but not dramatically. GDP slowed, but didn't collapse. Most households barely felt it. The Federal Reserve helped soften the blow by aggressively cutting interest rates. Ironically, those same low rates later helped fuel the housing bubble that crashed the economy in 2008. But that's a story for another video. Here's the thing though. The dot-com bubble wasn't all bad. The fiber optic networks, the data centers, the early internet platforms built during those crazy years, they became the foundation of today's digital economy. Companies like Amazon survived the crash and went on to dominate. So in a weird way, the bubble was both a disaster and a launchpad. Recap. The dot-com bubble was a speculative frenzy in late 90s internet stocks. It burst in March 2000, wiping out trillions in market value. It wasn't itself a recession, but it triggered the mild 2001 recession that followed. And the infrastructure built during the bubble years quietly became the backbone of the modern internet. And that's it. Now you understand what the dot-com bubble was and why it's not the same as a recession. You just got a money nudge. Hit that subscribe button. And we'll keep making money make sense, one video at a time.